What are you observing from Schwab clients as they enjoy price decline?
Well, I'm not sure they're enjoying price decline in bond funds, but what we are seeing is investors trying to take on a little more income by going into longer duration bonds. And this has been our call recently, to start gradually, not all at once, but gradually adding some duration as yields go up, because you have the opportunity now to get some relatively attractive coupons at prices that are often below par. So that means not only the opportunity to earn more income in a portfolio, but also potential capital gains.
Where is the biggest opportunity right now, Kathy, when you talk about those coupons? Is it in credit, and the riskier the better, or is it in full faith and credit U.S. Treasuries?
Well, I would slice it a little bit more carefully than that. There are two areas that we really like. One is municipal bonds. You can get on a tax equivalent basis for a very high income earner north of 5% in municipal bonds, high quality municipal bonds. We're okay with investment grade, but we want to stay a little more careful, because we do think we're going into, or we are in part of the credit cycle where we'll see some further spread widening. We're not crazy about the high yield, simply because this is the part of the cycle where high yield usually does most poorly. People forget that it's not the beginning of the rate hike cycle. It's usually the end of the rate hike cycle, when the economy's starting to weaken, that you start to see those high yield spreads really move out.
Kathy, I want to focus on that for a minute, because we saw a pretty big move in spreads yesterday in the high yield sector, which is something new. We really hadn't been seeing credit respond in the same kind of way that stocks had been responding. And yet suddenly we do see some sort of indication here. Is this just the beginning of a widening of a protracted sell-off in credit, or is this basically some sort of mini capitulation that will be viable for a lot of investors?
I think it's the former and not the latter. So I think that we have seen, say, triple Cs really underperform for quite a while relative to, say, the higher end of the high yield market. But as we get into higher rates, you're starting to see the impact on cash flow for those weaker companies with weaker balance sheets, maybe not as great at cash flow. It's one reason we don't like loans as well now, simply because we're starting to see the effect of the interest rate increases, and that's probably going to erode the ability to meet those obligations at the weaker credit. So definitely would not be chasing high yield at this stage of the game.
Kathy, there's a religion in the equity market that if you go down, correction, bear market, or worse, at some point you grow your way back to where you were, the market high. And there's long spans where this has been a challenge. How do you do that in the bond market? If I'm X% down from the summer of 2020, how do I grow myself back with yield if I don't have attendant growth underneath it like I have in stocks?
Well, it depends. If you're holding individual bonds and you hold them to par, you're still going to get your principal and your interest payments, barring a default, all the way along. So you've earned whatever that current yield was when you bought the bond. If you're in a bond fund, it usually takes longer, but usually what will happen in a bond fund is the manager is reinvesting for higher income, and on a total return basis over time, assuming that rates don't go sky high from here, which we don't think is likely, you earn your way back with the income component.